Hello everyone, welcome back to our channel. Today, we're diving into a topic that's crucial for every trader. Why do most traders fail? Despite its potential for profit, the Forex market can be challenging and unpredictable. In this video, we'll explore the common reasons why many traders struggle and provide valuable insights to help you navigate the world of Forex trading more effectively. So, let's get started. Segment 1. Lack of proper education. Let's delve deeper into the first reason why most traders fail in Forex trading: lack of proper education. This is a critical factor that sets the foundation for your trading journey. Introduction to Forex education. Followings are the key elements of Forex trading. Every trader should master these fields if she wants to succeed in this field. Understanding market fundamentals. To succeed in Forex trading, you need to start with the basics. Many traders fail because they jump into trading without understanding the fundamental concepts of how the Forex market operates. Like different currency pairs Euro, USD, GBP, JPY, etc. Exchange rates, bid-ask spread, and market participants. And the significance of understanding macroeconomic factors that influence currency movements. Interest rates, economic indicators, geopolitical events. Technical analysis. Technical analysis is another crucial aspect of Forex trading. It involves analyzing historical price data to predict future price movements. Explain technical analysis tools, charts, indicators, and patterns. Mention the importance of identifying trends, support and resistance levels, and using indicators like moving averages and RSI. Fundamental analysis. Complementing technical analysis is fundamental analysis, which focuses on economic and geopolitical factors that affect currency values. Discuss the impact of economic indicators, GDP, unemployment rate, inflation, and central bank decisions. Explain how news releases and global events can lead to market volatility. Reputable sources for education. Fortunately, there are numerous resources available for aspiring traders to educate themselves. Recommend online courses from reputable platforms, books written by experienced traders, and webinars conducted by experts. Highlight the value of interactive learning through demo accounts offered by Forex brokers. 5. Continuous learning. Forex trading is not a one-time learning process. To stay ahead in this ever-changing market, continuous learning is essential. Encourage traders to stay updated with market trends and news. Suggest joining trading communities or forums to learn from experienced traders and share insights. In essence, a lack of proper education can be a major roadblock on your journey to becoming a successful Forex trader. By dedicating time and effort to learn about market fundamentals, technical and fundamental analysis, and staying committed to ongoing education, you'll be better equipped to make informed trading decisions. Remember, education is the key that unlocks the door to success in Forex trading. Segment 2. Unrealistic expectations. Now, let's talk about a common pitfall that many traders fall into: having unrealistic expectations about Forex trading outcomes. It's important to set the right mindset to avoid disappointment and ensure a more sustainable trading journey. Introduction to unrealistic expectations. First thing, every new trader should understand that Forex trading is not a get-rich-quick scheme and that success requires patience, discipline, and realistic goals. Second thing, every beginner should understand that traders with branded cars, cash, etc. are misleading advertisements and online claims contribute to these unrealistic expectations. Promise of quick riches. One of the main reasons traders fail is the allure of quick riches. Many newcomers are enticed by stories of overnight success, but the reality is quite different. Every new trader should understand that Forex trading is a skill that takes time to develop, and consistent profitability is a gradual process. Importance of risk management. Trading without understanding risk management can lead to disastrous results, especially when fueled by unrealistic profit expectations. New trader might not know that. How traders who expect large profits might be tempted to overleverage their accounts, leading to substantial losses. Emphasize the significance of prioritizing risk management and preserving capital as the primary goal. Setting achievable goals. To counter unrealistic expectations, it's crucial to set achievable and realistic trading goals. Every trader, either new or experienced, should know the concept of SMART goal framework: specific, measurable, achievable, relevant, time-bound, and how it can be applied to trading. Encourage traders to focus on consistent, steady growth rather than aiming for massive profits from the start. 4. Patience and persistence. Forex trading is a journey that requires patience and persistence. Traders who expect quick results may give up prematurely. May lead to account wash and they lose all of their capital. For examples like successful traders, they set a goal of ROI 2% or 5%. Once they achieve their goal, they call off trading. The learning curve is a concept that represents the rate at which an individual or organization gains proficiency or mastery in a new skill, task, or activity over time. It depicts the relationship between the amount of experience or practice accumulated and the improvement in performance or efficiency. Key points about the learning curve include: initial struggle. At the beginning of learning a new skill, individuals often experience slower progress due to the unfamiliarity of the task and the need to understand its nuances. Accelerated improvement. With practice and experience, individuals start to understand the task better, identify patterns, and develop effective strategies. This leads to faster and more noticeable improvement. Diminishing returns. As the skill level increases, the rate of improvement begins to slow down. This is because the initial gains that come from mastering basic concepts and techniques have been achieved, and further improvements require more effort and refinement. Plateau. Eventually, the learning curve levels off as the individual. 1. While there may still be room for small improvements, the rate of progress becomes much slower. 2. Factors affecting the curve. The shape of the learning curve can vary based on factors such as the complexity of the skill, the quality and effectiveness of training or instruction, individual aptitude, and the availability of feedback and guidance. Aligning expectations with reality. Successful traders align their expectations with the realities of the market. This involves understanding that losses are a part of trading. 1. Discuss the importance of embracing losses as learning opportunities and adjusting strategies accordingly. 2. Mention the psychological aspect of trading and how accepting losses can lead to better emotional resilience. In conclusion, having unrealistic expectations is a common trap that many traders fall into. By understanding that Forex trading requires time, effort, and a disciplined approach, you can set yourself up for a more realistic and successful journey. Remember, it's about long-term growth and skill development rather than chasing quick riches. Stay tuned for the next segment where we'll explore another major reason for trader failures: emotional decision-making. Segment 3: Emotional decision-making. Emotions can often be a trader's worst enemy. Making decisions based on emotions rather than logic can lead to disastrous outcomes. 1. Talk about common emotional pitfalls: fear, greed, and revenge trading. 2. Discuss strategies for managing emotions, such as setting strict stop-loss orders and taking breaks when stressed. 3. Introduce the concept of keeping a trading journal to track emotions and trading decisions. Segment 4. Lack of discipline and strategy. Without a solid trading strategy and the discipline to stick to it, traders can easily lose their way in the Forex market. 1. Explain the importance of having a well-defined trading plan that includes entry and exit rules. 2. Discuss the risks of impulsive trading and going against your strategy. 3. Mention the need for backtesting strategies and adapting them to different market conditions. Segment 5. Neglecting risk management. Effective risk management is the cornerstone of successful trading. Ignoring it can lead to wiping out your account in no time. 1. Explain risk-reward ratios and how they impact profitability. 2. Discuss the concept of position sizing and not risking more than a certain percentage of your capital on a single trade. 3. Emphasize the importance of diversifying your trades to mitigate potential losses. Segment 6. Overtrading and fear of missing out, FOMO. Welcome back. In this segment, we're delving into a critical topic that can significantly impact a trader's success: overtrading and the fear of missing out, commonly known as FOMO. Let's explore how these behaviors can lead to failure in Forex trading and how to overcome them. Overtrading defined. Overtrading occurs when traders execute too many trades within a short period, often driven by the desire for constant action. 1. There are a lot of drawbacks of overtrading: increased transaction costs, higher exposure to market risks, and emotional exhaustion. Overtrading may lead to massive loss to trading capital at once. 2. Causes of overtrading. Overtrading can be triggered by various factors, including emotional impulses and the perception of missed opportunities. 1. For example, if a trader is continuously winning, it may generate greed to trade more, or on the other hand, if a trader loses one or more trade may lead him/her to take revenge trade. 3. Fear of missing out. FOMO. FOMO is another psychological trap that can lead to impulsive trading decisions. Example of fear of missing out, FOMO, in trading. Imagine Jane, a relatively new Forex trader, has been following the market for a few weeks. She notices that a particular currency pair, let's say EUR, USD, has been consistently rising in value over the past few days. The news and social media are buzzing with reports of traders making substantial profits from this trend. Jane starts to feel a sense of excitement and anxiety. She's worried that she might miss out on potential profits if she doesn't act quickly. Despite her trading plan advising against impulsive decisions, she decides to enter a trade on EUR, USD without conducting thorough analysis or waiting for her predetermined entry conditions. As the trade progresses, Jane becomes increasingly anxious as the currency pair starts to show signs of reversing its trend. She ignores these warning signals and holds onto her position, hoping that the market will turn back in her favor. Unfortunately, the market continues to move against her, and the trade results in a significant loss. In this scenario, Jane's decision to enter a trade based on FOMO led her to make an impulsive and emotionally driven choice. She neglected her trading plan, which would have required more careful analysis and patience before entering a position. Her desire to not miss out on potential profits clouded her judgment and resulted in a financial loss. This example highlights how FOMO can negatively impact trading decisions by causing traders to deviate from their strategies and enter trades without proper analysis. Traders who fall victim to FOMO often find themselves making emotionally charged decisions that lead to losses, emphasizing the importance of disciplined trading practices and managing emotions in the Forex market. Point 4. 1. Consequences of overtrading and FOMO. Both overtrading and FOMO can have dire consequences for traders' accounts and emotional well-being. 1. Discuss how overtrading increases the likelihood of losses due to lack of strategic analysis. 2. Explain that FOMO-driven trades are often made without proper analysis, leading to poor outcomes. 1. Combating overtrading and FOMO. Fortunately, there are strategies to overcome these behaviors and trade more strategically. Overtrading and FOMO can be detrimental to your trading success. By acknowledging and managing these emotional impulses, you can make more informed, strategic decisions in the Forex market. Remember, it's about quality over quantity, and staying disciplined will serve you well on your trading journey. In our next segment, we'll explore another common factor behind trader failures: emotional decision-making. So stay tuned. In conclusion, Forex trading can be both rewarding and challenging. By addressing these common reasons for failure and adopting a disciplined and informed approach, you can significantly increase your chances of success. Remember, learning from mistakes and continuously improving your trading skills will ultimately set you on the path to becoming a more confident and profitable Forex trader. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell. Until next time, happy trading!